Welcome to today's market report.
European stocks slipped from near record highs on Wednesday, with miners leading losses after concerns over China hit metal prices, while mixed corporate earnings reports and an upcoming central bank meeting kept investors on edge. The Pan-European Stoxx 600 closed 0.4% lower at 474.04 points after coming close to a record high on Tuesday. Miners led losses, falling 1.9% as Chinese intervention to address skyrocketing commodity price hit coal and metal rates. A mixed batch of earnings also weighed, with Deutsche Bank down 6.9%, despite posting a better-than-expected quarterly profit, as investors questioned the bank's reliance on volatile money spinners. French payments firm Worldline dropped 15.9% to the bottom of the Stoxx 600 on disappointing results and guidance. British blue-chip stocks fell 0.3%, while locally focused mid-cap stocks edged higher after the government flagged an improving outlook for the economy. Traders are now focused on the European Central Bank meeting on Thursday, where policymakers are expected to keep interest rate unchanged and push back on market inflation forecasts. After such strong highs we have seen on indices, I'm not surprised that we see a kind of breather today ahead of the ECB meeting. According to Soggen, the ECB will remain accommodative, but again, you always have the risk that any message or any word could be misunderstood or misinterpreted by the market. Soaring inflation expectations are likely to put pressure on the central bank as it considers how much support to provide the Eurozone economy once its pandemic bond buying expires next March. Despite the uncertainty, the Stoxx 600 is on track to gain more than 4% in October as stronger than expected quarterly results countered concerns about inflation and a global energy crunch. Profits for Europe Inc. are expected to increase 52% in the third quarter to 99.8 billion euros from the same quarter last year, latest Refinitiv data showed, an improvement from last week's 47.6% growth forecast. Among the day's gainers, a French household equipment maker SEB jumped 12.4% to the top of the Stoxx 600 after posting better than expected third quarter results. Electrical equipment maker Schneider Electric rose 2.4% after it reported better than expected quarterly revenue growth. Germany's Puma added 3.6% after hiking its 2021 sales outlook, even as it cautioned that a lockdown in Vietnam and port congestion and container shortages were hurting its supply chain. Crude oil WTI was down 3.06% at $82.06 per barrel. Brent oil was down 2.69% at $83.35 per barrel. Gold futures was up 0.27% at $798.25 per ounce. On the FX front, the GBP/USD edged lower, trading at 137.48. The London VIX lifted the pair as traders suddenly increased the bets on cable, jumping from 137.20 to current levels. Factors like month-ending flows, portfolio reshuffling, economic growth concerns, and US fiscal policy woes kept investors' mood negative, as witnessed by US equity indices falling. Safe haven currencies like the Japanese yen, the Swiss franc, and the US dollar benefit on a flight to safe haven flows. Rishi Sunak, the Chancellor of the Exchequer, reviewed a £75 billion budget in which he slashed taxes for pubs and restaurants, cut duties on alcohol, and increased the support for the nation's poorest, he said in a statement on the Parliament. Furthermore, UK's economy contracted almost 10% in 2020, but it is set to grow 6.5% by the end of the year, according to the Office for Budget Responsibility, OBR. Also, the OBR expects inflation to average 4%, double of the Bank of England's target, which the Bank of England has been aware of, as some policymakers had expressed concerns about elevated prices. In the US, durable goods orders for September contracted by 0.4%, less than the 1.1% expected. Eurodollars rebound from 115.85 lows witnessed during the Euro session has been unable to extend past 116.25 and the pair retreated to the 116 area. The dollar index is trading at 93.868.
This is today's market news. Thanks for listening. We'll see you next time.